My Fidelity account did something weird after hitting $100,000. The same monthly contributions that barely moved the needle suddenly became irrelevant. The portfolio started growing faster than I could add money to it. I'm about to show you exactly why this happened and the 4 specific index funds in my Fidelity account that created this explosion. Let me show you something. This is my Fidelity dashboard. Started with $8,000 in 2019. Crossed $100,000 in late 2022. Now sitting at over $300,000. The first $100,000 took me 4 years of grinding. The second $100,000? Just 18 months. The third? We're talking 12 months. The acceleration doesn't make sense until you understand the math. Here's what Fidelity doesn't explain when you open an account. There's a mathematical inflection point in wealth building. Before you hit it, you're pushing the boulder. After you hit it, the boulder rolls itself. When my Fidelity account had $20,000, a 10% year meant $2,000. At $50,000, that same 10% meant $5,000. At $100,000, $10,000 in gains without adding a penny. My monthly $1,000 contribution used to be 5% of my portfolio. Now it's 0.3%. The market makes more in a day than I save in a month. This is the shift that transforms your financial planning from active saving to passive wealth accumulation. Before I show you the exact funds, let me tell you what I did wrong first. From 2019 to 2021, I held 15 different positions in my Fidelity account. Individual stocks, sector ETFs, international funds, bond funds. I was diversified into mediocrity. Then I simplified everything down to 4 core holdings. Just 4 index funds that I could buy through Fidelity with 0 commission. No analysis, no research, no watching Jim Cramer. These 4 funds now comprise 95% of my Fidelity net worth. The backbone of my Fidelity portfolio, VOO, Vanguard S&P 500 ETF. Current price in my Fidelity account, $594.42. My average cost basis, $398.74. Current gain, plus 49.05%. This single fund gives me ownership in America's 500 largest companies through my Fidelity account. Apple, 6.67%. Microsoft, 7.39%. Nvidia, 6.57%. I own them all with one click. The expense ratio is 0.03%. Fidelity charges me nothing to hold it. Vanguard charges me $30 per year per $100,000 invested. I started buying VOO in my Fidelity account at $287 in 2019. Kept buying through COVID, through the 2022 tech crash, through every "this time is different" headline. 60% of my Fidelity portfolio sits here. Why so much in one fund? Because it's not one company, it's 500 companies. When one fails, another rises. The index self-cleanses, dropping losers and adding winners automatically. My Fidelity account shows VOO up 29.23% year-to-date. That's nearly $60,000 in gains this year alone on my VOO position. My second largest Fidelity holding, SCHD, Schwab, U.S. Dividend Equity ETF. Current price in Fidelity, $27.87. Dividend yield, 3.08% year-to-date return, plus 27.87%. Here's why SCHD matters for compound interest in my Fidelity account. Every quarter, Schwab deposits cash dividends directly into my Fidelity cash position. Started at $80 per quarter. Now it's over $500 quarterly. That's $2,000 plus annually in pure passive income streams. I set up automatic dividend reinvestment in Fidelity. Those quarterly payments buy more SCHD shares, which pay more dividends, which buy more shares. The compound effect is ridiculous. SCHD's holdings aren't speculative garbage. Chevron, 4.27%. Altria, 4.27%. PepsiCo, 4.25%. ConocoPhillips, 4.21%. Companies that have paid dividends through every crisis imaginable. My Fidelity portfolio allocation, 20% SCHD. During the March 2020 crash, when my Fidelity account dropped 30%, those SCHD dividends kept hitting. Psychological gold when everything else was blood red. Here's my controversial Fidelity position. QYLD, Global X Nasdaq, 100 Covered Call ETF. Monthly distribution yield, approximately 11%. My Fidelity position, 10% of portfolio. Every month, QYLD deposits cash into my Fidelity account. Not quarterly like most dividends, monthly, like clockwork. Here's how it works. QYLD owns the Nasdaq 100 stocks, then sells covered calls against them. The option premiums get paid out as distributions. The catch? Limited upside. When tech stocks moon 40%, QYLD might capture 10%. But when markets are flat or falling, I'm still collecting 11% annually. My Fidelity transaction history shows consistent monthly deposits. January, $428. February, $431. March, $425. I use these distributions for two things: funding my lifestyle without selling shares, buying more VOO during dips. My financial advisor friends hate this position. Too much tax drag, limited growth, complex strategy. They're right about everything except one thing. The income is real, and it hits my Fidelity account every single month. My fourth Fidelity holding, NOBL, ProShares, S&P 500 Dividend Aristocrats, ETF. Current price, $105.32. 52-week range, $94.42 to $108.42. This fund only holds companies that have raised dividends for 25-plus consecutive years. Not just paid, raised. Every single year. Through recessions, wars, pandemics. My Fidelity position, 10% of portfolio. Why hold NOBL when I already have SCHD? Different purpose entirely. SCHD is for dividend growth. NOBL is for stability. When markets panic, these aristocrat companies fall less. They're boring, predictable. Exactly what prevents me from panic selling my Fidelity account during crashes. The psychological benefit is huge. During volatile periods, I can look at my Fidelity portfolio and see NOBL holding steady while everything else gyrates wildly. Companies like Johnson & Johnson, Coca-Cola, Colgate-Palmolive, they're not going anywhere. People buy toothpaste in recessions. They drink Coke during depressions. Here's exactly how I manage these four funds in my Fidelity account. Once per quarter, I check my allocations. VOO, target 60%, SCHD, target 20%, QYLD, target 10%, NOBL, target 10%. If anything drifts more than 5% from target, I rebalance. Fidelity makes this stupid simple. Sell what's overweight, buy what's underweight. No commissions, no fees. The entire process takes 15 minutes quarterly. I don't check my Fidelity account daily. I don't watch futures. I don't read analyst reports. I don't care what the Fed might do next week. I just let these four funds compound in my Fidelity account while I live my life. Why Fidelity specifically? 3 reasons changed everything for my investment portfolio. 0 commissions on ETF trades. Fractional share purchasing. Automatic dividend reinvestment. That fractional share feature is crucial. When SCHD pays me $500 in dividends, Fidelity automatically buys $500 worth of SCHD, even if that's 17.94 shares. No cash sitting idle. My Fidelity account also shows me total return including dividends. Most brokers only show price appreciation. Fidelity shows everything, making it clear how much these dividends contribute to wealth building. The interface is boring compared to Robinhood. Good. Boring prevents emotional trading. Let me show you the actual math from my Fidelity statements. 2019 to 2022, grinding to $100,000. Monthly contribution, $1,000 to $1,500 annual return, approximately 12% average. Time to $100,000. 4 years, 2023 to to 2024. The explosion. Same monthly contribution, 1,000 to 1,500 annual return, approximately 18% average portfolio gain, 200,000 plus in 2 years. The contributions stayed the same. The market returns were slightly better, but the dollar gains went parabolic. Why? Compound interest on a larger base. $100,000 gaining 18% equals $18,000. $200,000 gaining 18% equals $36,000. $300,000 gaining 18% equals $54,000. My salary is $75,000. My Fidelity account now makes 72% of my salary without me lifting a finger. These funds will not make you rich overnight. VOO will crash 40% in the next real recession. Guaranteed. SCHD will cut dividends if earnings collapse. QYLD will massively underperform in bull markets. NOBL will bore you to tears for years. But here's what I learned after my Fidelity account crossed $100,000. Short-term volatility becomes irrelevant when compound math takes over. My Fidelity account dropped $47,000 in September 2022. I felt nothing. Why? Because I knew the math would eventually win. 6 months later, it had recovered and added another $30,000. This is the confidence that comes after $100,000. You stop fearing crashes and start hoping for them. There are opportunities to buy more at lower prices. If you're starting from zero in Fidelity today, start with 100% VOO. Build to $25,000. Add SCHD at $25,000. Go 70/30 VOO/SCHD. Consider QYLD at $50,000 if you want income. Add NOBL at $75,000 for stability. The exact percentages matter less than consistency. My success wasn't about perfect allocation. It was about buying the same 4 funds every month regardless of headlines. Set up automatic investing in your Fidelity account. $500, $1,000, whatever you can afford. Make it invisible. Make it automatic. My Fidelity net worth exploded after $100,000 because I finally understood the game. It's not about picking winners. It's not about timing markets. It's not about finding the next Tesla. It's about owning broad index funds and letting math do what math does. These 4 funds, VOO, SCHD, QYLD, NOBL, aren't magical. They're vehicles for capturing long-term wealth creation through compound growth. Your Fidelity account can do exactly what mine did. The same funds are available, the same math applies, the same compound effect waits. The only variable is time and discipline. Start with VOO. Add the others as you grow. Ignore the noise. Trust the math. Your future Fidelity net worth will thank you when it crosses that magical $100,000 threshold and starts building wealth faster than you can contribute. The explosion is coming. You just need to position yourself to catch it.